It's June 2nd, 2022. Alex Cole, how are you doing, my friend?
I'm doing okay.
Yeah, top of the morning to you. Markets have been fascinating. Potential for change, lots of inflection points. Let's dive right into the charts at this week's GoNoGo show, starting with that cross-asset heat map, just kind of giving us a general overview of the landscape. What do you see on this chart, Alex?
Yeah, so there's been an up and down over the last couple of weeks. We've had some really strong volatile days down and up, and this week and last week we've had a bit of a relief rally, but the trends look as if they're remaining the same across the assets. So equities are still in a no-go. Yes, it's weakened to pink bars, but still the weight of the evidence suggests a no-go. Treasury bond prices have stayed in their no-go, and that trend has strengthened this week. Commodities and the dollar both staying in go trends and strengthening. And of course, Bitcoin continues to struggle, having tried to rally earlier in the week, sort of fallen away from resistance.
Absolutely. Great piece out from Ned Davis Research talking about historically what a bottoming process looks like. And I think the question on all analysts' minds right now is, sure, that was a low. Is it the low? And what we're trying to assess here is all of that checklist, all of the weight of the evidence that people use to understand a sentiment extreme, a flush out or a capitulation where you have massive selling. And there's still conflicting information amongst where valuations are at. Has there been enough destruction to say that the low is fully in? But we want to focus on what is appearing on the charts. We don't want to forecast the market. Instead, we want to obediently and in a disciplined way react responsibly to what's happening on the charts. So, Alex, let's take it off of this asset class heat map. Let's dive into the equities, specifically the sectors of the S&P 500 on a relative basis to the index. What are you seeing here?
Well, there's one big change here where we see technology relatively outperforming and painting a paler aqua go bar. So that's interesting. We saw that they were painting amber bars. We talked about that at the end of last week. We see the same thing with communications coming out of the no-go into amber bars. And then on the flip side, we're seeing some change in the more value sectors that we're leading, or the more defensive sectors. Staples is painting no-go bars. Healthcare and industrials are painting amber go fish bars. So like you said at the outset of this, some inflection points everywhere as we look across the sectors.
So just for a quick review, for those of you who are new to the GoNoGo show, thanks for checking us out this week. What we're looking at is a blend or a composite of all of the most widely tested technical indicators, but we're using that weight of the evidence in a very simplified manner. So we're color coding the price charts according to the strength of the trend. So when we're in bearish no-go conditions, we're in pink and purple. When we're in go trends or upward trending bullish conditions, we're in aqua and blue. And then when you see those amber bands, what we're talking about is when all of the inputs to the indicator are in their neutral position. We know that it's best to just go fishing. The market is still trying to find direction. So at the far right of this sector relative strength heat map, we're seeing a lot of change, maybe a shift in leadership, maybe a rotation back towards growthier equities, riskier assets like technology over staples. So, Alex, let's move on and let's look at the price action itself in the S&P 500, just to take a look at what this rally has shown us.
So this is the daily chart of the S&P using the ETF, of course, the spider. And this is the question on everybody's minds this week. Is this a relief rally? If we try to get involved with this, are we guilty of trying to sort of catch a dead cat bounce? Or is this, like you said, the actual low and we're ready to move higher and see a change of trend back towards a go trend? Well, weight of the evidence, it's still a no-go. The no-go is weak, but it is still a pink bar situation. What we are seeing, though, which is interesting, is the oscillator. We pulled out this bullish divergence over the last few weeks, but now the oscillator breaking above the zero line into positive territory, really sort of causing a bit of concern for the no-go trend. We know that if this trend is healthy, the oscillator should stay at or below the zero line. So this is some encouragement for bulls for sure, but the trend itself remains a weak no-go.
And as always on this show, we're not trying to tell you what time frame you ought to trade or what securities you ought to trade. If your practice, if your investment process has you on much shorter intraday time frames, then obviously that rally. We're going to look at some shorter time frames in just a second. We're going to see that in Go trends. But if you're looking at the daily chart as your main time frame to trade, the way we would think about a life cycle of the trade in this case, if you were shorting the S&P in this bearish trend, certainly when that oscillator breaks above zero and you see positive momentum in a no-go trend, we know there's a real threat to that potential continuation of the downward movement. So covering shorts at this point makes sense. But as Alex said, the trend conditions have not yet proven that reversal to a go trend. So guilty until proven otherwise. We are seeing some of those divergences and now positive momentum, very encouraging signs for the bulls. But Alex, let's, as we always do, take a look at some multiple time frames on a weekly basis. What are you seeing in that strong no-go purple bar there on the far right side?
Yeah, so the flip side of being bullish in terms of what you're seeing there with the oscillator is wondering whether this is a sell the rally kind of moment. And so we step out of time frame, you go to the larger time frame, and you see that we are in a strong no-go environment with the oscillator testing the zero line from below. So we know that if this finds resistance here and rolls over back into negative territory, most likely this is a swing high in a no-go trend. So we might be then looking at the daily, having that kind of information and thinking, okay, I'm going to be very careful here because the larger time frame trend is a no-go.
Absolutely. And now let's take the reverse. Let's take a look at a shorter time period. A 2-hour chart would be great. So as we were saying, if you are an intraday trader, you might be even trading faster than this, but that relief rally, that bear market rally, could be an interesting swing trade if you were looking short term for that rally. Alex, what do you see from a go-no-go trend perspective on this 2-hour chart?
Yeah, I mean, absolutely. If you're trying to, get involved with price action moving higher within a larger time frame no-go trend, yes, you could go down in time frame to find entries. And right now we're in a go trend. We see this recent go trend here, and perhaps as long as we see support on the oscillator, that would have been a good entry point to get involved in any kind of rally that continues from here. But on the other side of that is if you are of the opinion that the no-go on the daily is still in place and on the weekly we're still in that strong no-go, you may be looking down in time frame just to re-enter when conditions are right to the larger no-go trend. So you would have been taking all of these entries into the short or into the no-go as we've been in a no-go on the daily and the weekly over the last few weeks. And you might be now waiting to see what happens here with this fresh go trend. If this doesn't find support here and we get back below zero, you might consider that an aggressive way to get back into the no-go trend, or maybe you'd even wait for this to go back to a no-go on the 2-hour. But depending, again, like you've said several times, we're not telling people how to trade, but depending on your strategy or your horizon or your time horizon, you could certainly be looking at this different ways.
And certainly midday on Thursday, June 2nd, this looks like another inflection point for the 2-hour chart where the oscillator is at zero, building the squeeze. We're on weak go trend. Potentially that's just a consolidation before further upside. But we want to understand both scenarios. So having a trading plan for either outcome is just the responsible way to go.
And like you said, in knowing that the larger trends are no-go, you would be wise to set tight stops, right? So even if you're trying to get in early and capitalize on a rally and a reversal, you certainly would want to have your stops tight, because generally speaking, if the no-go trends are in place on the larger time frames, these go moves are less likely to be profitable right before they roll back over. So you definitely would be setting stops probably at your entry or getting out if the oscillator breaks zero, making sure that your risk management is really tight if you're trying to go against the larger trend.
Absolutely. So, Alex, let's turn our eye for a minute. You and I have had the great fortune of reading the great works of John Murphy and Marcos Katsanos. We've talked a lot about intermarket analysis. We also get to work with really great global macro analysts. So, let's turn our eye to the US dollar. We're going to try to understand if there are any signals from the other asset classes that would tell us whether conditions are improving or potentially ready for further downside in the US equities markets. So, talk to me about what you see on this US dollar, the UUP being the investable ETF capturing the dollar index fund.
Yeah. So this has been a surprise trade, I think, for a lot of people this year. People have been calling for the demise of the dollar a lot earlier than this, and it hadn't really happened yet. Now we are seeing threats to this go trend in the dollar. You can see after these recent highs where we got the counter trend correction arrows, these red arrows, we can see that we have corrected, and we've corrected strongly enough to cause the oscillator to fail to find support at the zero line. If you look at the go trend so far through the dollar, it's been supported by the zero line predominantly. Every time we see a rally in price, we see a correction, the oscillators generally found support at the zero line. And that's what we would have expected here if this go trend was to be healthy. So this correction has been large enough to push the oscillator below the zero line. So we're looking at this now as a bit of a concern. Obviously, the weight of the evidence says that the trend is still a weak go, but if the oscillator stays below zero for much longer, we're probably likely to see a change in trend above.
Absolutely. And so strength in the US dollar obviously has big impacts on emerging market equities. If we could just let's pull up a chart of the EEM and see how that is behaving with this recent rollover in the US dollar, and see if we're beginning to catch the start of something new here.
Look at that, prophetic, Tyler. Yeah, I mean, it is the degradation of the go trend in the dollar certainly has repercussions, and certainly we can see the impact of that around the world and the emerging markets. This is the EEM ETF, and we can see that we got some signs that this no-go trend was in trouble when it broke out of this max squeeze a few days ago. But now today, based on today's price action, again at about lunchtime Thursday, we are seeing the start of something new. And we've seen this flickering this morning between an amber bar and a go bar. So depending on where we close, this may well end up being an amber bar. But definitely something happening here. There's some change happening. The oscillator quite clearly broke out of that squeeze into positive territory. And now we're seeing trend change, color change above in price.
So 2 quick points that you touched on. One is that during the day, that bar is reacting in real time to what the trend conditions are as they change. So it's a daily bar, and intraday that will oscillate between a go and amber, depending on how the conditions change. Once the day is closed, that bar is unchanged. So for everybody who's using these charts, you can see that in real time. They're never revised or restated. The other thing to point out on this chart is that we've been in this bearish no-go trend, and really kind of predominantly through that trend, we saw that the oscillator could not get above zero. Retesting, being rejected, had that little flicker in early April where we bounced to a amber bar and then came back into the no-go, specifically as the oscillator rolled back over and below zero. Now we saw the buildup of a max squeeze where that bottoming process might be taking place. You've got that tug of war between bulls and bears on the investability of emerging market assets. And when that squeeze resolves to the upside, right, we know that compressed volatility leads to potentially larger moves and certainly trend reversal when that oscillator has been depressed below zero. We've had negative momentum throughout this run. It's really interesting to see that inflection play out that way. And we'll obviously be looking to see how today closes and how the week closes to confirm whether or not this is a new trend that we want to participate in. Alex, let's switch gears again. Obviously, US dollar, emerging markets, but the rates, really the rising rate environment in the US has been the large headwind to growth equities, sectors like the technology, communications, discretionary. And when we saw on that sector RelMap, the relative strength, seeing technology begin to outperform the index and seeing staples grossly underperform the index, it makes sense to check in on where yields are going and what you're seeing from a trend perspective here on the TNX.
Well, we're getting some conflicting information there, because I think that the relative outperformance we're seeing in those growth sectors would lead you to think that rising rates would struggle to continue to rise. What we're seeing here, though, on the TNX chart is that this downward sloping line here is on the chart from our sort of 25, 30-year downward sloping trend line, where we've seen that incredible, historically low rate environment. We've seen this threaten to be broken. And on the daily, you can see how we did get above that. And then we came back toward it, and we painted some amber goldfish bars here. So lining this up with what we're seeing in that sector RelMap, okay, that starts to make a bit of sense. Maybe rates come back. Maybe that's healthy for the growth sectors. Maybe that's a bit of a tailwind for stocks in general. But the last 3 bars here, we can see that rates have returned to a go trend, and they've come higher again this week. And that's caused the oscillator, which had dipped below the zero line, to come right back to it. So a couple of things could happen from here. Often when we see this kind of activity from the oscillator, when it breaks below it for the first time and then comes back, and if it rolls over here, then it might dictate what we see here in price, and we might eventually move to a no-go. But if the oscillator can get back above zero quickly, then we're back in a go trend for rates, which would conflict a little bit with what we're seeing in terms of the growth sectors starting to perform better.
So to paraphrase, right, this TNX chart, what yields are doing, that rising rate environment is going to have a big impact on where sector leadership is going to take place. We're in what we saw in the S&P 500 as a bear market relief rally. We've had a strong bounce, and certainly it could bounce further. But what we're looking for here is that intermarket relationship. And if yields roll over to the downside, potentially, right, anything could happen. Jay Powell and friends could say, yeah, forget tightening, right? We want to be prepared for that. And if that is the case, then we're going to see more leadership from those growth equity sectors. But if we see this trend continue as it is right now in a go trend, and if that oscillator breaks back up above zero, then we would expect those further headwinds for growth equity sectors, and potentially further downside for the index as a whole, as risk off behaviors take shape. Alex, let's take a look at a few individual securities, and then we'll wrap up today's show, starting with Change Healthcare, which you pulled out for our institutional subscribers on Monday morning in this week's flight path note. What are you seeing from a trend perspective here?
Yeah, I pulled this one out. It's a very interesting chart, because you can get a real sense of traditional technical analysis, and it interested me. Healthcare at the beginning of the week was still in a relative go trend relative to the market, and so you're in a sector that's been outperforming for some time, and there's a lot of reasons on this chart to expect prices to move higher. Primarily, this massive gap here, which we know that gaps tend to be filled, but we also know that gaps provide support. So when we saw this correction of price turn to amber bars, oscillate to below zero, we're watching very closely here to see what happens, because we're at the bottom of that gap, where we know that often would provide support. And it did. We got a counter trend correction arrow, a bullish short-term counter trend correction arrow here on the during these amber bars, and then we saw this long run of amber bars. This was really interesting, because you don't often see that many amber bars as GoNoGo trend makes up its mind. Then we saw the oscillator ride the zero line for an extended period of time, building up a max squeeze, and this NoGo bar here could have really tricked us, but we were still riding the zero line. And then when we broke out of the zero line, this is what we sent out on Monday, this new go trend, and now we're testing the highs since the gap that we saw back in April. So this is an interesting point for this security. It's in a go trend, it's testing these highs, and we're in positive territory on the oscillator. So just an interesting chart.
Fantastic, and what a great view on some classical technical analysis. Obviously, we want to see how this plays out from a trend perspective, but understanding where those key levels of support and resistance are is critical to the trading process. Alex, let's turn our eye to Big Brother in the crypto land, Bitcoin. We want to look at this on a long-term basis first. Let's start with the weekly, just so we can kind of see where we've come from. And talk to us about what you were noticing, what went out in the research note Monday morning.
Yeah, everybody has been talking about the massive support that's around 30,000 or just below, 30,000, 29, 30,000. When you pull the chart back, you can see where that comes from. It comes from all of the clustering of price activity at this level. You can see correcting back to that level, touching it several times before going again. So since this weekly no-go trend has been in place, we rolled over again and dropped quite quickly to those levels. And we actually, on a daily intraday basis, we went below them, but we closed higher. So we found the support at that level. That's a really significant level of support going back a couple of years. And so now we've been looking at price trading in the range between support at these levels that have come from back here on the chart, and then the resistance levels that come from the clustering right above those levels. So if we go then back to the daily chart, we can see this is what we're talking about. And on Monday, we were looking at this and saying, okay, well, we're approaching this resistance level. Let's see what happens. And we fell away from it very, very quickly, and we're back in the range. So, an interesting moment. The one thing that I will point out that is what typically happens before a trend change, but of course it could go the other way. But we have seen the oscillator break into positive territory and is now finding support. So if it finds support here at the zero line, that would give a little bit of a push to suggest that we may be able to make an attack on these highs again. So lots to look out for there, but Bitcoin is still trading in its range.
Certainly. I think for the HODL gang and the diamond hands and the laser eyes, they were looking for a sharp bounce right off of 30,000 and back to the moon. Obviously, that did not take place. So when what you expect or wanted to happen doesn't happen, then the opposite is true. And this consolidation at 29,000, right? There's something constructive to be observed about it not rolling over a lot further, but getting into this tight range between 29,000 and 30,000, certainly a very interesting moment for Bitcoin and the entire crypto asset space. We saw massive destruction in the Terra Luna Ponzi scheme, and I'm sure there's a lot more that will come out from federal investigators on that. We're much more interested in what price is doing, what investors are doing to put their money to work. So watching here for a real key inflection point as to whether or not we can get back above that 30,000 if we break out of this range, or if we are intended to roll over further and send it a lot lower. Alex, what a fantastic view across the world's asset classes, indices, sector groups, and a couple of individual securities. Couple quick notes for those of you who are watching this show on YouTube. Thanks so much. Give it a like. Make sure you're subscribed to StockCharts TV. But if you're also interested, check out StockChartsTV.com. That's the on-demand portal where you can watch GoNoGo Charts and many other really valuable shows throughout the week, wherever you carry your mobile device. We also want to invite all of you to join us at 5 p.m. Eastern on June 15th. We're going to take a much longer form view to how we use these tools, concepts like relative strength, and how you might look at the life cycle of a trade using GoNoGo Charts, and having those four key components of trend, momentum, volume, and volatility without all that analysis paralysis and clutter on your charts. So we're looking forward to spending a lot of time with you this summer. That special event, June 15th, here on StockCharts TV. We will also be speaking June 27th at the Metastock Online Traders Summit. Stay tuned for more information about that in the coming weeks. And of course, we'll see you in July at the Wealth 365 conference. We're going to be spending a lot of time online together, Alex. I'm looking forward to it. Certainly plenty of excitement in the markets to talk about.
Yep.
Excellent. Well, for all of you, thanks so much for watching this week. We'll see you again next Thursday.
guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.